Welcome back from the break, everyone. That voice of God is very familiar to me. It's actually my co-host, Carol Masser, on Bloomberg Business Week. I did not know she was God. That's why she acts that way. I didn't. It's all coming together. Anyway, just a little levity for mid-morning here. I hope you guys are all having a good morning. Actually, since Marty's from Atlanta, I feel more comfortable saying y'all. Hope y'all are having a good morning. We've got really just a baller lineup here to talk about the asset management world. And coming out of that video, it strikes me, as we heard all about North Korea and South Korea, Suni, you and I were joking backstage, just like talking about various countries. One thing they have in common is they both fought wars with the United States. So we're living in a rather volatile time. David, I want to start with you. Is volatility good for your business at this point?
So in general, as a long-term investor, volatility is not the same as risk. And I think that's one of the most important concepts. Our clients lose money when we sell an asset for less than we bought it for, or if we've actually taken a permanent impairment. But day-to-day volatility in the market is not risk, and actually can be the way that we get into securities at attractive prices. So if you take, for example, the fourth quarter of last year, many people in the investments world say, well, that was a really tough quarter, right? I mean, and certainly financially for many of us, it was. But for our investors, it was actually an excellent quarter. It allowed us to put money to work into credit, into emerging markets, into high yield, into equities, at prices that really were very attractive. And because we believed that the economy was fundamentally in good shape, we took advantage of that. So in general, I would say volatility is a rather strange concept, should not be confused with risk, and changes in asset prices actually are generally good things for long-term investors.
All right, so I'm glad you mentioned the fourth quarter of last year because, Suni, it felt like it was a moment that came and went, and yet the last few weeks have felt a little bit more, especially if you're investing in tech, like the fourth quarter did. So where are we now as it relates to volatility and as it relates to risk? Pick up on what Dave was putting down there.
It's funny you say that because coming in here, we had been looking at year-to-date stats. And I said, let's go back and look at September 30. And we're well down from where we were just 6 months ago. So it's a very, very different market. I think just following on that theme, volatility breeds a lack of correlation, if you will, among the asset classes. So I'll go in a different tangent, just talk about when you're looking at a portfolio of asset classes and an evolving world where we really aren't diversifying by asset class anymore. We're diversifying by factor. Volatility can drive a view on what those factors are and how they relate to one another. So I think we're going to see, again, more opportunities as the volatility increases here.
Marty, what does outperformance look like in this more volatile world? Where do you find the alpha?
So you're asking an interesting question. So one, let me come back and answer another way.
Sure.
I think we talk about outperformance, and I think where we as an industry sort of miss the mark, we need to meet our clients' stated outcomes and the risk they want to. And I think there's been way too much focus on beating the benchmark or not. And I think it's really generating the outcomes for the clients, which is the most important thing from my perspective.
And how are you doing that these days?
So David started to hit on it. It's really a well-diversified portfolio of different asset classes. And again, it really has to reflect what the client wants.
Right.
And I think today, investors are in a position where they can build the most robust portfolios that they've ever been able to do with a number of developments over the last number of decades.
So Suni, pick up on that because well-diversified for sure, but that assumes that you're able to kind of get into the places you want to get into. We heard from a couple giants in the alternative space sitting on these couches just earlier this morning. Alternatives have delivered quite well, especially the top performers. But can everybody get to them?
Yeah, no, it's hard, and I think we're seeing a tremendous amount of interest, not just in alternatives, but now they want to be pre-IPO, right? The form that alternatives are taking, a lot of the value is taken out of the market before it gets to the traditional, ironically, traditional alternatives space. So I think that is one of the reasons you're seeing such a growth in that space, but it is trying to find exactly that, those one-off opportunities.
So David, on that point, I feel like this is something you and I talked about a couple years ago at the Milken conference, this idea of fewer public companies. I mean, there are markedly fewer than there are. With these unicorns that are going public this year, we've seen them much, much longer in the tooth in terms of staying in the private markets. Is that a secular or a cyclical change? And what are the implications for your customers on that?
So we believe that it is both, but it's fundamentally secular. The private markets have really taken the place in many ways of funding growth companies in the US particularly, but we're seeing it around the world as well from the public markets. And if you go back to the kind of the tech decade of the 90s, what every technology company wanted to do was as quickly as they could go public. That's not true today. You would simply show up and you get Series B, Series C, Series D. You actually generally want to stay private as long as you can. There's an enormous amount of venture and kind of pre-IPO money that's available to fund that. And so growth companies are not actually going public anymore.
Right.
What that means is there's a lot less growth stocks in the public markets. We've had a fall by more than half of the number of publicly listed companies, as you mentioned. And I actually think this is bad for the economy as a whole. As a big institutional investor, because we actually can access private equity returns, we're okay with that. But if I look at the societal view of that, people with 401k plans, people who have historically been able to participate in the dynamism of the American economy, no longer can, at least in a traditional way. And so I'm certainly hoping that we see the public markets take a long, hard look at themselves and make some changes, both in terms of regulation, in terms of how they monitor and measure themselves, so that they can more effectively compete with the private markets.
Marty, great, you're nodding.
Yeah, I couldn't agree more. And I think the reality is it's become a lot harder to be a public company in the past, and it's a lot more expensive. And as a management team, you really want to take a long-term view. You should manage your companies that way. And there have been just different pressures, way too short-term pressures on companies. And I think that's been a big driver. And the good news is I know Chairman of the SEC is very, very focused on it, also recognizes, one of the reasons the United States is viewed so highly is in finances the depth of the capital markets, and we're starting to take that away. So it's something really important for all of us to focus on.
Having said that, I think the asset management industry is adjusting, right? We're being creative on product creation.
Yeah.
You're seeing the onslaught really of private credit funds.
Yeah.
A lot of the fund of funds, which was a model a lot of people dismissed a while ago, now they're into co-investments and whatnot. So I think there's an expansion going on in terms of product offerings to try to help make up for that lack of product.
Go ahead.
Build on that a little bit. I think that actually the industry is fundamentally changing in response to that. So it used to be there was a world of alternatives, and we heard the Apollo story this morning, and then Bridgewater and others, and then there was the long only. And these are now coming together, as you heard from Apollo, and that's true for the others as well. They're all getting into private credit. They're getting into long-only businesses. And many of us that have historically been in long-only are getting much more focused on alternatives.
Yeah.
Our business model as PGIM, we've been always very balanced across public and private, with a big real estate business and a big private credit business. And so we believe the future model actually will be people who are good at both, rather than having these two separate worlds.
All right, so that leads to, I want to come back to private credit in a second, but you gave me too good of an opening to talk about consolidation in the industry. So what does that look like? I mean, are you guys on stage? Are you buyers, sellers, as you start to rationalize this new world? What do you do about that? I'm going to stick with you since you brought it up.
So I think we have to be careful about the word consolidation, because I think people tend to mean big mergers, and we'll let Marty talk about that in a moment. But but if what you mean is that are the large players winning share over others, the answer to that is absolutely yes.
So consolidating market share, maybe not M&A.
And the reason for that is client-driven. When you talk to the very largest pension plans and sovereign wealth funds around the world, they say, we used to have 250 external managers. And we have discovered that we've just put together the most expensive index fund we could possibly have. And so we are going to really dramatically downsize this. So we're going to do more business with less people. And the bar for being one of those partners is going way up in terms of capabilities. So that is really driving a need, I think, for global capabilities in the business. Now, we can come on and talk a little bit about what that means for the competitive landscape, for each of us.
So Suni, pick up on that. I mean, so what does it mean? Like, what is that sort of narrowing of the pool? And I mean, I liked how Dave put it, the world's most expensive index fund.
Look, it means that the industry is not going to look at all like it does today 5 years from now, maybe even a shorter time frame.
But what does it look like? So
Well, so there are going to be winners and losers, right? I think you need to provide solutions. So for all of the clients that are looking at it that way and can afford to have a team that can allocate, they'll find the beta providers and they'll strip that out and they'll focus only on the alpha. So if you're an asset manager, you better be delivering. If you're delivering beta at all, you better be delivering it really cheaply. You can't hide it, right, under your active management. And we've got factor analysis now in the tech that tells you exactly who's provided alpha and whatnot. In fact, we've got regulations now trying to demand how we prove value for the fees that our clients are seeing. So there's a tremendous amount happening there. You have to be unique, right? You can't just be the long-only tech or biotech fund that's going to sit there and wait for things to happen. You have to more actively trade the opportunities that are there, which is unique. There's an article in the Times this morning about outsourcing trading. Think what that means and how that could affect the industry. How are we using data? And just the whole thing is going to be very, very different. So I think you're going to have a barbell at the end. You're going to have those that are truly unique, have access to those alternatives, can provide that OCIO type servicing and the technology that goes with it. And then you're going to have the boutique niches that are over here that are going to do, maybe just the passive or just real estate or whatever it's going to be. But I think that middle ground is the ground that's shrinking.
So in that middle ground, Marty, do people just go out of business? Like, what happens?
Yeah, I think David said it, properly. I've been in the industry since 1983, and even since that period, you've heard the industry's going to consolidate, and people took it too literally that, little mergers and acquisitions. And let me make this point: it's an $88 trillion industry still growing. So a lot of people think the industry's going away. It's not going away. It's changing dramatically for the simple fact David laid out that wherever you go in the world, whether it's U.S. wealth management platforms, sovereign wealth funds, they are using fewer money managers and expecting more of us. I look at Invesco today, cap-weighted index, factor, high conviction active, alternative. I never thought that would be a business from when I started the career. Many more firms, the winners are going to look like that because of all the reasons that been spoke of up here.
And so what's implicit in one of the things you said, or maybe explicit, Suni, is the notion of fees. And obviously, people are paying more and more attention to that these days. Talk about the expectations that clients have at this point about what they're willing to pay for, because we've talked about alternatives. Clearly, many of the alternative managers are still able to command pretty high fees. But to your point, if you're not delivering alpha, you better do it as cheaply as you possibly. That beta better be cheap.
Yep. Yeah. I don't think anybody wants to pay for beta at all. First of all, right? So I think the demand is for transparency, and to that end, MiFID. One of the studies that just came out post MiFID in Europe was that most of the investors had no objection to paying for research. They just wanted to see the alpha as a result of that investment. So it's less about cheap, because you might get what you pay for, and more about the transparency to understand that we've got their interests at heart and we are being efficient with our excess or with our efforts, and that we are then delivering the alpha that pays for that.
So then, David, does the fee sort of structure and the way that customers think about fees change? Do how you pay and what you pay does it all evolve?
So I think it does evolve. And if I can, let me come back to the fee question, because I do want to address the consolidation point that you asked earlier and kind of what does the industry look like. So every year, the bankers release another report that say, big consolidation, lots of mergers, we're going to have even more deals than we had last year, and it never happens. So why
in the world would bankers do that?
But the industrial logic is clear. There is overcapacity. There is real room for size. But the reality is this remains a profession and not a business. So what I mean by that is that we have a fiduciary duty to our clients, which comes before our duty to shareholders. And that is different than if we made cars or watches or anything else. And so when we do a merger, it's not at all clear that that's good for the client. Their question is, well, what happened to my portfolio management team? And is my returns going to be down? So from our point of view anyway, we really believe in the people and the talent and the culture that we've built, and we don't want to disrupt that with a lot of big mergers. And so you see many fewer of them than a pure industrial logic would lead you to.
So Marty, I want to pick up on that before we get too far away. I'm going to distill down what David just said to mergers are really hard.
I heard that. Yeah.
You haven't been, you have some experience
really
here.
easy. I don't know.
You know.
Yeah, it's this is a really, really important point. If you go back to this notion that all of a sudden the industry is going to consolidate, doing mergers, they are difficult. I've happened to be in a career of going through these. There's a way to do them and a way not to do them, and the vast majority of people get it wrong. Because on a piece of paper, it looks like it makes a lot of sense. That's exactly the wrong way to go about it. You have to start by, are we a better client? Can we do more for our clients putting these two firms together? The next thing is, are we culturally aligned, yes or no? And if you're not, you will have a problem. It's just a matter of when will you have the problem? And that's where it goes wrong. And so the notion that there'd be this massive consolidation amongst organizations that have never done one, the likelihood of success is not very high.
Can I ask you a question before we get off of this? I just want to ask you a question about culture, because I feel like we talk about it all the time.
Absolutely.
Culture is so important. We talk about it a lot here, and it is. It's important to the guy whose name is on the door, and it's important to many, many leaders. Give me an example if you can, or tell me about something that you've experienced over the course of these things where you said, okay, this doesn't fit culturally.
Yeah, and again, David hit this point. We start by, we are legal fiduciaries. We have to be focused on our clients. And when you start to have a conversation with somebody and they talk about how much money they're going to make, stop the conversation.
Yeah.
And the other thing, I've always had a strong belief that how should you think about your business? Take care of your clients, run a good business, and you will become big enough because you've done a good job. I never was a believer in scale. And every time I heard somebody talk about
With that.
size, how big we're going to be, and all they talked about was that's what mattered, I knew it was going to be a problem.
Isn't it amazing, Marty, how many CEOs actually have an AUM target?
Yes. And it's,
I mean, why is that in my client's interest for me to get bigger? In fact, I could make the opposite argument.
yeah, it is
I
very,
think
very
it's
true.
fine.
And I think but I will say what's different this time, for all the reasons we've been talking about, you literally have to have operational scale, but you can't lose the thought of clients first. And I think that's a really important thing.
I
to
mean,
stay
when you
focused
think
on.
about the concern, I think, and maybe hopefully why we haven't seen a lot of the acquisitions or the mergers you're talking about, taking two firms that are not positioned for the future and putting them together. So now they're bigger and they have scale, but they have not addressed the problem. The operational scale we're talking
That's
about,
right.
the investment in technology that we're talking about, the change in approach to how you're using data, whatever it is. The ideal merger is going to be someone who's got that but doesn't have scale and can bring this more traditional asset manager along. Those would be interesting combinations. I'm not sure there are many of those available.
Well, I'm not going to make any of you say it, but I feel like the code word here is Germany in many ways when you think about some potential mergers that have been discussed in the last year. I'm just going to leave that out there.
I'll leave that for her. So let me take your point on culture one step further. So we operate in a multi-manager model. One of the reasons that we really believe in that and why it generates excess returns is that we actually think the culture for different asset classes is very different. Why would you think a real estate business that operates largely like a private equity business with carry and a whole kind of client logic like that would look the same as our quant equities business, or look the same as our fundamental equity business, or look the same as our private credit business? And so we actually believe in having quite differentiated cultures that are built around investing in that asset class. And they really are different. And we actually celebrate that rather than trying to bring that all together.
Right.
I'll take the expanded version of that because I don't disagree with that at all. But when you talk about something like ESG or sustainability and you're trying to build a core capability that you want to put across all of those asset classes. I think there's a benefit for being centralized, part of that being the operational side of it, part of that being regulatory reforms and all the control things that we have to put together. So, so exactly, we keep our business areas, as we call them, separate, but have combined them so that from an infrastructure perspective, from a launch like sustainability, we want to change the culture of that investment process. We find being centralized helpful.
Right. I don't want to get too far away from something you mentioned, Suni, and then David just said it as well. Private credit has just ballooned, exploded into this industry of itself, in and of itself, in a way that we certainly didn't see before the financial crisis. It does feel like one of these sort of secular changes in the market where big banks largely got out of this business. It raises a whole bunch of questions around shadow banking and all those, kind of murky areas. How excited/worried are you about that piece of the market right now?
So we have a very targeted private credit fund as part of O'Connor, which is our hedge fund. And it's, again, scalable, but we're not talking about the massive. We don't do wholesale loans. We're not doing CLOs. We're not doing some of the stuff that's a little murkier, if I use your phrase. But we're filling a niche, right? So we can turn a loan to an individual for $20 million in 7 days with multiple assets as collateral. There is not a bank on the planet that can do that. So the flexibility that we can provide as investors, provides a real added value, I think. But every time we talk to the Fed, they're asking about that shadow bank and how we all were here for the crisis. I remember having that conversation before the crisis too. So there are things to be concerned about there, I think.
So we're obviously a very large private credit provider. We manage about $80 billion. And because of our history as an insurance company, we kind of think it's odd that asset managers have only recently discovered lending, because we've been doing this for 60 years. And yet we do worry a lot about what's happened. So for people who do largely investment grade, which we do, and people who do direct origination, which we do, so we get to know the management team. We're not just doing agented deals. We actually feel very comfortable with the credit, and if you look at our track record, even through the great financial crisis, it was very strong. But now you have a lot of people that don't have that history and experience who are buying into agented deals. You have BDCs that have come out. And we would say this is going to end badly. There's going to be quite a lot of people who lose their shirts because they got into this late and don't really have the credit skills to do it and don't understand the value of covenants, which is what we really hold the line on, even more than pricing. Now, the only
could this cause the next crisis, private credit?
So it could absolutely cause a repricing in credit. The good news is that this isn't on banks' balance sheets. So the LPs are going to lose a bunch of money in all of this, and some of the GPs are going to go down. But it should not have the ripple effect throughout the banking system that we had from the last time. But I mean, we are absolutely stand ready to get the distressed debt team cranked up on this area, because it's coming.
And so that's it's a really interesting point that's not going to be the systemic thing. Marty, what do you worry about from a systemic level in terms of the next crisis? And obviously, if any of us in this room knew what the next crisis was going to be, probably wouldn't be sitting in this room. We'd be, doing something else, buying something.
Yeah, I guess the point is there's not always, the crisis that you're referring to. I'm really where David is. Whenever you see an asset class where people are just piling in, we can look back in history and it never ends well, right? I mean, go to the dot-com period and go, you pick it throughout decades, it just doesn't end well. And so the real people that get hurt are the investors, right? And I think that's really probably the reality of what's going to happen next.
So in the couple minutes that we have left, I did want to ask you about some current events, most notably what's going on with the trade war, whether that, especially as it relates to U.S.-China relations, is having any direct impact on your business. I know you guys have a joint venture, Invesco Great Wall. Do I have that right?
Yep.
So how does that play through that firm?
So I'll go back really to last year. There was thought in the marketplace that the trade wars weren't impacting business. It was impacting our business. We had clients that were doing risk off in the area, and that was last year when there was some common belief that we'd get to a positive outcome. It's clearly much more worrisome now. I think most of us thought an outcome was weeks away. It now looks months away, and I think that's just not good for business at all in any of our businesses, and also the strength of the economy and all these other things we were talking about a few minutes ago. That said, I get pretty practical on things like this. This is a really bad outcome for both China and the United States, and something will get done. But time is not our friend, right? So you could literally have the pressure on the markets in the meantime, ultimately because of the outlooks and earnings and the pressure on the economy. So I'd say it's not a great thing. Again, probably many of us visit China quite often with our businesses. You talk about in these conversations, really the portfolio for about 3 minutes. Then you're talking about geopolitical, events going on, and trying to get a sense of it all. And I'd say the vast majority of all of us, whether it be Americans or Chinese, would want to get on with it, and that would be my strong message.
For you specifically, does it slow down any talks about this joint venture?
No, we still have very, very strong relations. I mean, I think the vast majority of the people are very hopeful something will happen. The problem is when, and that's not a good thing.
And Suni, what do you make of it? I mean, because I believe you guys have
we have a JV in China, and we've been there for decades, right? We are all in, but I think the long-term view is necessary with all of this noise coming in and out of Mr. Trump's Twitter account. So yeah, we're still very bullish. I think you're right. I think it's made a lot of clients cautious, where we had a lot of people coming in. Having said that, I'll be the ever optimist as I am.
Good.
It's raised awareness. And we get a lot of query about China and what does it mean. And when you hear about these trade wars, now we're looking sector by sector. Who's it affecting? Talk to me about the service economy in China. It's not all about manufacturing commodities anymore. How does that play out? So it's a very different dialogue than we would have had a few years ago on the topic, which I'll take as a win.
Yeah, that's a good point.
And so, David, are your teams essentially reallocating, making different decisions now based on exactly what Marty said, that we're not talking about days, we're not talking about weeks, we may be talking about months, we may be going into 2020 with this unresolved?
No, I think we may do. And I spent actually about half of April out in Asia visiting our large clients. And what I would say is that the general view of large institutional investors is that the tariff piece is a small part of this. It's about the broader relationship between the two largest economies in the world. And it goes from, trade on the one hand, but also intellectual property, technology, and supply chains. And we need to make progress on the broad set of relationships. And I think so most people's hope is we can get the tariff thing behind us and use the momentum from that to move on to these more fundamental issues.
Well, because ultimately what's concerning people is that we may see essentially a decoupling between China and the United States.
And in Asia, they worry about that hugely. I mean, I had exactly Marty's experience. I mean, we had 3 minutes on the portfolio and 60 minutes on, even in Japan around what's happening with China. But what I would say is, and I won't go on a long rant on value at risk models, I promise you. But I do think that political risk is not priced into the market appropriately. The market is really good at will the Fed cut rates? Because there's a defined set of outcomes. We can all have our different probabilities. You can put that into the models, and out will come a result. Political risk is very different. There are no defined necessarily outcomes. We can't even predict what they'll be. And there's a wide range, often with big tails, on probabilities. Our approach to markets don't work well in that. And historically, what you see with political risk is actually that there's too little volatility for quite a while. There's essentially kind of nothing happens. And then we have an event and the markets move in a very big way. And right now we have the VIX at 18, which is its long-term historical. That is too low. And we are not yet pricing in the risk that actually is intrinsic in the political landscape that we live in today.
Well, on that happy note, we're out of time, unfortunately. But thank you all so much, David, Suni, Marty. We really appreciate your time. Thank you, guys.
Thank you, Jason.